What if you could collect rent from elite tech stocks without ever buying 100 shares? Sounds illegal. It is not, and Wall Street has used it for decades. That is the promise of the poor man's covered call. Same strategy, same idea, a fraction of the cash. Use a sliver of the capital, then chase 20 to 40% annualized returns. Today, we decode the classic PMCC playbook, step by step with real numbers. First, the classic covered call. It needs 100 shares parked in your account as collateral. Then you sell short calls against those shares and collect option rent every single month. Here is the pain. Quality tech stocks can demand $50,000 up front before you earn a dime. The poor man's version swaps that giant stockpile for one single long option. That option is a leaps contract, long dated, deep in the money, built to act like stock. With high delta, it moves almost dollar for dollar with the shares. Nearly identical behavior, far less cash. Think of it like a low down payment on the same house. You still ride the appreciation. You just carry a smaller mortgage. Picture Adobe trading near $500 per share. 100 shares? About $50,000. Ouch! So step one is simple. Buy the substitute warehouse, not the whole building. Find a call that expires beyond 365 days. Time is your friend here. Demand a delta above 0.8. That keeps the tracking tight to the real stock. That deep call might cost near $10,000, not $50,000. Capital tied up falls by roughly 80%, instantly. Same exposure, way less cash. Step 2. Become the landlord against that rented position. Sell calls that expire in 30 to 45 days, short cycles, faster rent. Choose a delta around 0.2 to 0.3, comfortably out of the money. For calm stocks, that strike may sit 3 to 6% above the current price. For jumpy tech names, it can be 7 to 12% higher. That cushion absorbs ordinary monthly rallies while the rent keeps arriving. But before you click buy, here is the iron rule. The short strike minus the leap strike must exceed your net debit paid. Net debit simply means option cash paid minus option cash collected. If shares moon assignment can still leave the total book profitable. That is the whole point. Now the fun part. What does the rent actually add up to? In this example, spend $10,000 on the long Adobe call. Then sell monthly calls, collecting about $250 each cycle. 12 cycles make $3,000 of option income. 3,000 over 10,000 equals a 30% cash yield. And if Adobe grinds higher, the leaps itself can appreciate too. Cash flow plus capital gains can turn a solid trade into a spectacular one. But theory is cheap, so let's stress test 3 real outcomes. Scenario 1. The slow bull becomes your monthly ATM. Imagine paying $4,000 for a 1-year Duolingo call. A delta near 0.8 keeps you glued to the stock. Shares climb gently and never smash through your sold strike. Every month, $200 or $300 lands in your pocket. After 6 months, rent alone returns $1,500. Meanwhile, the long call swells toward $5,500. That is the dream. Double-dipping income and upside at the same time. Scenario 2 is uglier. The floor disappears. Think the trade desk during its brutal 2025 sell-off. Your short calls expire safely, and the premium suddenly feels tiny. But the long leaps bleeds right alongside the collapsing stock. Deep in the money can become at the money, then worthless. Sell calls above break-even and the rent dries up completely. Lower the strike, and one rebound can force a losing assignment. So this remains a bullish strategy for businesses you truly want to own. Scenario 3 is the weird pain. Your stock rockets upward. Good news smashes the price straight through your short call strike. That sold option loses fast, while fear of missing out punches you in the gut. Do not panic. Roll up and out with discipline. Buy back the endangered short call, even at a loss. Then immediately sell a later call with a higher strike. Yes, one leg hurts, but the hedge math still matters. Your leap's delta near 0.8 outruns the short call near 0.6. Each $1 pop nets about 20 cents for the combined position. You are still winning, just slower, and now with a raised ceiling. Rolling works when the new premium collected beats the buyback cost. You trade time for space and avoid paying out of your own pocket. But earnings can detonate 15% overnight. Do not be heroic. On extreme spikes, close both legs and bank the max profit. Locking a 30% annualized gain is already elite performance. Before you dive in, dodge 3 rookie traps. 1. Demand liquidity, because wide bid-ask spreads quietly eat your profits. 2. Respect earnings season, when volatility can crush both sides of the trade. Consider flattening before reports instead of gambling through the confetti. 3. Options pay no dividends, so exclude them from your totals. Bottom line, this is a small account lever for patient bulls. Use 20% capital to control quality tech cash flow. It shines in sideways grind and gentle uptrends, not crashes. So tell me, which tech stock would you choose for this? Drop your ticker and your thesis in the comments below. If this helped, like, subscribe, and ring the bell. This video is for educational purposes only and is not financial advice. Next time, more hard data on Wall Street option machines. See you then.